Hello, everyone, and welcome to BFW 2401, Week 7 Credit Risk. Now, this week, we will cover credit risk single loan, which is Week 7. Now, in Week 8, we will continue with the credit risk, which is one of the most important, the core actually of banking. And it will be in Week 8, we will talk about portfolio risk. Now, let's put Week 8 away now, and let's talk about what we are going to do in this week. Now, in this week, I divided the recording into 3 parts. The first 2 parts are introductory slides. So I will give you some background about the credit risk framework, which is introductory slide number 1. This is around 3-4 slides with some explanation. And then introductory slide number 2, which I will talk about very important issue that we will discuss in credit risk called credit scoring. And then we will go to the main part. Now the main part, the second part also around 3-4 slides. And the third part, which is the lecture of today, of this week, which is around 27 slides. Now, what we call the part 1 and part 2, which is the introductory 1 and introductory 2, you are not responsible about that in exams or tests or any other things. You are only responsible about the main part, which will come, which is the 27 slides. Why I have done this, why I'm doing this, because last time all those slides were in the main slides. And I don't want students to prepare for it and study for it while I'm not covering it. I'm only bringing it to explain the concepts. And those concepts are very important also to understand the main part, which is the 27 slides. So please take that to consideration. And let's start with, let me share, please, and let me go with the part 1 of the introductory slide. So this is actually this is what I'm talking about. So we are now talking about the introductory slide number 1. And then this is, as I told you, the credit risk framework and introductory slides. Number 1. Now, if you look at the where the balance sheet, where the loan portfolio is located in the balance sheet, as we know, it's in this area, and we are talking about only in this area. Later on, we will talk about the other assets, which is securities portfolio, but now we are talking just about the loan, which will cover Week 7 and Week 8. Now, before we talk, when we talk about loan portfolio, we have to understand what is this credit risk framework and where does it come from? We understand now the credit risk is just the defaulting of the loans, and it can come from so many places, and can come to the picture because of so many reasons. And the way to understand it is to look actually to the framework. So if this is the framework, as I told you, this is the framework of the credit risk. And when we talk about credit risk, we can talk about transaction risk. This is actually in Week 7. And we can talk about portfolio risk. Now, when we talk about credit risk, transaction risk, we talk about 3 issues: transaction, selection risk, underwriting risk, and operational risk. What do we mean by those 3 things? See, when we give a loan, a housing loan, assuming it's for 30 years, it's actually a financial partnership. You are choosing someone to be with you financially for the next 30 years. He will pay interest, principals, he will receive a loan now. So it's like if you want to look at it from another perspective, in life, for example, when we decide to get married, somebody like you, 18, 19, 20 years old, maybe, you will get married within the next 10 years or something when you start your family. Now, the most important thing when you get married, for example, in our social experience, is to select the right person to stay with you for the next 70 years. That's what you want to do. And so if you select the right person, now in this time, in this issue, you have to have some understanding, which is the contract. I mean, how you are going to run this life, what you are going to do. Maybe you discuss kids, we discuss, so many things that's going to happen in this, social, what you call a partnership for the next 70 years. So you have to select the right person. You have to agree on the issues, and this is before you get married. And after you get married, you have to maintain this contract. You have to maintain it, to revisit it, to do all these things. And then if you select the right person, if you agree on the principles of partnering with this person, then in this case, you have to maintain that relationship and revisit it, as I told you, every time. So this is a social experience. Now think about a loan, which is a partner for the next 30 years. You need to choose the right customer. And then you have to have the right loan, the right contract in terms of pricing, how much you would price that loan, in terms of the covenants, which means the terms and conditions in that loan, in terms of so many things you have to do it, which is the terms, pricing, sources, repayment, collateral, all those issues you have to agree on if the person actually fit for this loan. And after that, if you select the right person and you sign the contract, then during the life of this 30 years of the loan, you have to maintain it. So there is a potential failure for the payments, the compliance with this contract. So you have to have right documentations. You have to monitor that loan. You have to have early detection of problems with the loans. All those issues, you have to do it when you do a loan. Now, after that, as we will go to talk about it in week 8, we will talk about portfolio risk. Now, portfolio risk has nothing to do with the loan. The loan could be, all those 3 issues could be excellent, no problem about it. The problem is you choose, for example, an industry that is, you buy or you concentrate your loans in some industry that have intrinsic risk. For example, you go with the oil industry, or you go with the high-tech industry. Now, technologies and oil and all these things, they have this volatility in earning, and they are very impacted. For example, technologies are impacted, they can get obsolete very fast. So if you concentrate your loans with, most of your loans with, firms that working in IT, then you have to be careful about that. Also, when you do it with oil. Also, sometimes when you have 90%, 80% of your loans, and some banks have done that and they failed because they take 80%, 90% of the contract for housing. And when there is a housing bubble or whatever, any problem in those issues with the housing industry, the whole loan portfolio goes bad and high defaulting, and we have seen this in so many places and through so many financial crises. Now, this is the intrinsic risk, which means you have to know that when you also the loan and the customer and the contract and the operational risk is under control, but there is an intrinsic risk in this industry. Also, when you do a concentration, You know, sometimes you just, as I said, the industry can be very risky by itself, but also the same thing, most of your loans is going in some geographical area, in some industry, or in some market niche that make a very concentration risk. And concentration risk, you can look at this example which I gave you for the housing. For example, housing, or you can talk about farming or technologies, whatever. When you concentrate 80 or 90% of your loans with one industry, regardless of that industry, then you go to portfolio risk. This is the whole framework, whether you are talking about single loan or talk about portfolio. Now, portfolio is a different issue. It's because of the intrinsic risk or because of concentration risk. But transaction risk have a selection issue, have a contract issue, and have operational issue. Now, this is the most important thing, because if you miss in the single loan, the selection, if you select the wrong partner from the beginning, everything you do after that is just a waste of time. Because if you like the subprime, when they selected the subprime during the financial crisis, they know whatever is the contract, they are going to default later on. So this is the most important thing, which is the selection area. Now, the selection area now, I cannot come to each customer, and whether we are talking about retail banking, which means retail loans, or business loans, or huge business loans, we have to, we cannot evaluate each customer individually. So what we do, for example, for housing loans, for car loans, even for credit card loans, when we talk about single loan, we will have what we call credit scoring. And this credit scoring actually will tell us what to do. You know, they will have a benchmark, and they will talk about it in the next slides. In the next part of this introductory slide, which is introductory slide number 2, they have what we call benchmarking. You can use it for business individual loans, or you can have it for business loans. Now, individual loans, we can have the personal information of the borrower, and started to, you know, break it down, gave it scores for each, you know, characteristics of the borrower, like the age, the income, the number of the family, the history, the education, the area where they live. Even in the US and some other countries, they can use race, all those issues. So, and they give score for each one. And when you put the application, you have to fill all those things, and they will give you a score. And then the bank had both a benchmark score. If you pass that score, you will be granted the loan. If you don't pass it, you don't grant the loan. The reason I'm talking about selection risk in this stage, because all the modeling, we will have it in part 1, the main part 1 of this lecture, is actually about selecting the right one. And we, for businesses, we used to select the right business, to honor the application, and to grant the loan is to use the financial information, financial statement information of the business firm, and see and try to score it, and then decide whether to grant the loan or not to grant the loan. We will talk about this later, but this introduction is very important. Now, I give you these 2 issues, for example. This is just an additional cases from the industry. Now, in the industry, for example, if you look at Maybank, they have a risk management. They have risk management for their, what we call IB, which is the investment banking. And they have they have 3 systems. They have one system, which is the line 1 of defense, which is responsibility. This is what we call risk management systems. This is actually day-to-day management of risk, and this has to be based on some systems. And then you have second line of defense. This line is actually responsible for setting and implementing the risk management framework and the following tools and methodologies for identification. You have to identify the risk, you have to measure it, you have to monitor it, and you do the pricing of the risk. So this is actually like a research area where they can identify risk areas. And this, of course, has to be provided for the first line, so they can use it from day to day as the footprint for their daily activities. And the third thing is, of course, to bring auditors. And when you bring auditors, the auditors will see whether things are here and here are in place. Now, Maybank used main approach for Maybank IB to manage credit risk. They have two systems, and every single business, and especially in banking, we have to have a management system, risk management system. They have the risk management system called ERM, which provide a framework for risk management, which typically involve and identify particular events or circumstances relevant to the organization, which means they will identify those issues. And actually, this is coming from the second defense. So they will try to identify risk areas and the events that will create those areas, this risk. And then in the same time, they will have to have some type of tools to deal with this risk. So they will identify the impact, and then they will determine the response strategy and monitoring process. So actually, for example, if you know that you have portfolio risk, then in this case, the best way to do is to deal with either to increase the diversification. And when you increase the diversification, you actually hedge most of your risk through diversification, or you can buy what we call derivatives to credit default swaps and other type of insurance to protect you against the credit risk. Now, this is one issue just to give you some information about what's happening in the industry. IT has been involved a lot with the operational risk. And for example, this Equifax, this is a case published, and they introduced a system called Interconnect. Interconnect goes and check all the system. It's like a robot, a program, a code, and actually they will see whether there is any fraud in the outstanding loans, and they actually did. So they checked around 900,000 loans applications for this bank, and they found around 14.6 million fraud that recaptured again. The whole system cost around $400,000, but actually the bank saved around 4.2, because 4.6 that way they get back. 400 goes to Equifax, and 4.2 was retained by the bank, which means recovered by the bank for this fraud. The reason I'm bringing this story is that we have now robots and sophisticated codes to help us in managing the operational risk, which is this area, whether we are maintaining the contracts we are maintaining the contracts during the life of the loan as per the contracts or no. This is Equifax actually was doing this. Now, thank you very much. This is actually end of introductory for slide 1, and I will start in another video for slide 2. Thank you, and let me just stop this, and we'll see you in the next introductory slide. Thank you.